Hello, everyone. My name is Peter. I run the Insights team here at Carta. Deeply appreciate you spending some time with me this morning, this afternoon, or this evening, depending on where you are. I'm going to give a couple of moments here for people to come into the stream, but today we're going to be running through everything Carta knows about what the heck happened to startups in 2024. We've got 100 slides of data. I must tell you here at the top, we're going to breeze through some of them, and you're going to be annoyed because I didn't spend enough time on the data that you loved. Don't worry, you will have access to this deck immediately following the recording. And of course, you can rewatch this live stream whenever you'd like, right at this link. So I promise, we will be touching on all of your questions as well. Speaking of, if you have questions and you are watching this on LinkedIn, you can just go ahead and comment on the LinkedIn Live, and I can pop those up right into the screen. So, hey, Kirk, welcome. Hello. Hey, Natalia, welcome. Or hey, excuse me. Hey, much better. So as that question comes to you, throw it up into the comments. And if I think it's a great one, I'll post it on the stream. Okay, let's go ahead and get started with this huge deck of data. So we're going to run through things like funding context, the co-founders, the safes, valuations, AI, anything and everything that you can think of. What happened in 2024? Before you ask, of course, you can get this deck. As I mentioned, there'll be a link in the LinkedIn stream below, or you could email me if you'd rather, peter.walker@carta.com. I like to kick things off in a fun and sexy way with a note from our lawyers. I won't read it for you, but just let everyone know this is, a well-formed and thought-out operation here. So we have 8 sections to get through today. That's quite a lot of data. Again, I'm going to be ripping through some of them. I'm going to be spending more time on others. So if you have questions or you want me to go back, throw it into the comments. Let's dig in. First things first. Though it may not have felt like it, 2024 had more investment into Carta companies than they raised in 2023. So we are no longer falling, finally. We've had 2 years of a pretty rough feeling across startups. Hopefully 2024 felt slightly better. About 85 billion raised last year. I think that number is going to increase just a little bit as more data comes in at a lag, but that compares pretty favorably to the 75 billion in 2023. Of course, we should just ignore that wild, wild number from 2021 if we want to feel better. And of course, I'll just say this at the top. If you were going into this talk thinking that I'd avoid the word AI, you will be sorely mistaken. We're going to talk a lot about AI. This chart shows you that it is not just an early stage phenomenon. AI companies are raising huge amounts of cash at every single choke point across venture capital. So from Series A to Series F, AI is the story of 2024. So getting back to that idea of a feeling or a vibe, one of these years was not like the other ones, and it wasn't this year. So if you're going to take one thing away from how we should feel about venture capital, it's that comparisons to 2021 make everything feel worse, because that was the outlier. That's when everything went a little bit wild, and we overfunded, let's be honest about it, at high valuations and overfunded companies, and we are dealing with a lot of that hangover today. So what's happening right now in venture, it feels hard. It usually is hard. And that's the trouble, is that 2021 was a little too easy, and it's screwing up our frame of reference. I'm noticing in the chat, yes, definitely good to notice. This is all data from Carta companies, so companies that use Carta cap table, and it's all US data. So if you are from an international locale, thank you so much for joining. We're not going to touch on data from your part of the world today, but hopefully you can take some of this US data and make some adjustments to it to think about what's going on in your market. So number one, nobody escaped this downturn, right? It wasn't like seed companies did really well and late stage companies did really poorly. Everyone has seen a decline in funding, no matter the stage that you're looking at. And for the entrepreneurs on the call, the first and immediate impact of that lack of funding is you need to probably change your assumptions about how often you will fundraise. So if you're planning on fundraising during the usual timeline, which used to be every 18 to 24 months, that is out of date. You probably want to have enough cash on hand for 2 years at the minimum. So it may take you 28, 30, 36 months in order to raise that next round, and you have to stay alive in the in-between period. And these gaps mean that the entire ecosystem is affected by this time lag. So if it's taking longer to fundraise, then obviously those companies will stay private and not IPO for quite a lot longer. And indeed, that's what we see. The median age of a company that's IPOing these days is something like a dozen years. Well, that has deep impacts to your VCs, yourself as founders, the LPs that are looking to invest into those funds. Everyone is affected if private companies stay private for a dozen years instead of 7 or 8 years. So what have venture capitalists been doing this year if they seem to not be investing in new companies? One of the things that they're doing is they're spending a lot of time and attention with the current portfolio companies that they already have. So this shows you the percentage of rounds on Carta by stage that were bridge rounds. Usually a bridge is for a flat or slightly up, could be slightly down valuation. And it's led by people who are already on the cap table. And if you raised, say, a Series A, then the bridge would be named, say, Series A hyphen preferred 2, something like that. You can see that bridge rounds take up a lot of share in seed and Series A, but we're starting to see them creep back down in Series B and Series C. I think that's really healthy. Bridge rounds shouldn't be the main focus. They should be sort of the appetizer, not the entree for venture capital. Nick, you asked a great question. How do we account for the fact that Carta is growing and more companies are just on Carta? We haven't done any normalization here, but all of the medians and aggregations would sort of elide that difference. When we talk about overall numbers, the fact that we have more companies on Carta in 2024 than we did in, say, 23 or 22 actually makes the decline from the peak in 21 probably a little bit more impactful. So things probably a little bit worse than these numbers showed in 23. Other stuff, down rounds. Used to be a big stigma about them. Now they take up about 20% of all rounds on Carta. That's a huge amount of rounds. So founders out there, if you're thinking that only you are going to have to take a down round, I got to be honest, there's a lot of founders who are founders of great companies who have taken a down round in 23 and 24. And those down rounds sometimes come with strings attached. Even the up rounds sometimes come with strings attached. So this is a look at the liquidation preferences available to founders on each one of these rounds. Anything over 1x, we consider a high liquidation preference. We see that deals with at least or more than a 1x liquidation preference, they've become a lot more common at the later part of the venture ecosystem. So those deals are favorable to investors. And the reason that founders take them oftentimes is because they don't have a better option. So we do see that the market dynamics and what deal terms are quote unquote standard is very sensitive to the macro environment in which those deals are happening. This session is definitely being recorded. You can find it right after it's done at the same link. So what does that mean if you're a fund manager? Well, one of the things that it clearly means is you've got all this turmoil going on with your underlying portfolio companies. The main question for you is how many of them are going to get to the next stage? And caveat here, we understand as a group on this call, the point of fundraising is not to fundraise to the next stage, is to have an eventual wonderful outcome for your investors, your employees, and yourself. But VC funds are often judged on getting their companies from, say, seed to Series A. So it is important for the VC fund manager to understand how quickly should I expect my companies to jump to the next funding round. Well, in the middle of 2020, so if you read this chart down the y-axis here, 2020 Q2, about 40% of the seed stage companies that raised a seed round in that quarter got to a Series A in less than 2 years. 40%, that's huge. But if you were looking at the seed stage companies that raised in 2022, it's only 15%. So that means that a lot less companies are graduating to the next round, meaning a lot more companies are stuck at the round that they currently raised. And what happens if a venture-backed company is stuck and cannot fundraise for a long time? well, that company shuts down oftentimes. Now, this looks like a pretty serious increase in shutdowns, and it is quarter over quarter. But remember, we funded a whole hell of a lot of companies in 2021. So unless we got much better at picking winners, which there's no evidence that we did, you would expect if we funded more companies, then at the end of 2 to 3 years, more of those companies would shut down because only a small percentage of VC-backed companies ever IPO or get bought. So in some ways, this increase in shutdowns, it's expected. And that doesn't make it any easier for founders or employees who are going through it, but it isn't a complete shock to everyone who's watching venture capital. That's depressing. That was not a fun overview, right? It hasn't been it's been an interesting, but perhaps not entirely beneficial 2023 and 2024. Couple points to remember. One, the abnormality was 2021. The world we're living in now is much more usual, much more typical than 2021 was. Second, startups are incredibly sensitive to whatever the hell else is going on in the economy. Interest rates, inflation, regulatory changes, all of that stuff affects startups, even though we don't really talk about them as a significant part of the underlying economy as often. And the third, there was an AI boom that happened at the beginning of or the end of 2022, and it's happened during a venture downturn. So you got a boom on one eye and a venture downturn on the other. It makes things more confusing, let's be honest. Co-founders and early teams. We do a whole hell of a lot of reporting on co-founders and early teams, so I'm going to breeze through this really quickly. There's an idea about how much of your company, if you're a founder, are you going to own when you end up IPOing? Well, I'm happy to tell you that on January 21st, so next week, very, very soon, we are going to release the largest ever study about how much equity startup founders own at every single stage: seed, Series A, Series B, etc. We're going to break it out by CEO ownership versus the whole founding team, the founding team versus the investors, the founding team versus the employee option pool, everything from about 42,000 companies. So again, largest ever study done on how much equity startup founders will hold. If you want a copy of that, you can scan that QR code now. I think it's going to be a really impactful report. From our data, one of the clear trends is that solo founders are becoming more common. More companies are being founded by a single person. The tricky part is that most of those companies don't end up taking VC funding. So VCs still tend to prefer co-founding teams, whereas it seems as founders are often going it alone for the beginning. Some of them will probably add a co-founder later on, but VCs still tend to prefer people who have a founding partner. Most of those founding teams do not split equity 50-50 or 33-33-33, et cetera. It's still not the norm, but it has become more common. One of the reasons that VCs tend to prefer founders that have a teammate, co-founding teams, is that a lot of founders end up having a breakup between themselves at some point along this ride. So after 4 years, for the companies that are still in business, about 25% of them have lost a co-founder. So as you can imagine, if you're a VC, that's a real problem because who's going to lead the company? Bringing in an outside CEO is very difficult. Obviously, it won't happen to you. You and your co-founder are going to the moon. But for other people, it's actually a fairly common occurrence. So what does that mean for founders? There's this debate about how long your vesting schedule as founders should be. One, you should have a vesting schedule. Everyone should, mostly to protect yourself in case a co-founder leaves. Some VCs are bandying about the idea that founder vesting schedules should start at 8 years. Seems a little excessive to me now that I've really thought about it. I think the standard 4-year vest is a good starting point. You could do 5 or 6 if you wanted, and then you'll be kind of asked to revest sometimes along the way by different VCs. If you're paying advisors in equity, just know that what they're asking for is probably pretty high, and what you should give them is probably a little bit lower. The median equity grant we see to pre-seed advisors is 0.25% of the business. When you think about how much of your company as a founder you're going to set aside for your employees, the number 20% gets thrown around a lot. That's mostly for unicorn companies. You can start at 8%, you can start at 10%, and then as you fundraise, you get more and more, you give more and more allocation to those employees. So no need to over dilute yourself as a founder up front. You can start at 10% and go from there. If you're hiring early employees, the median amount of equity that the first hire at a startup got in 2023 was 1.5%. And in 2024, it was just a little bit below that. So it's about 1.5% is the median. And then you can see if you're hire number 3, you get less than that. If you're hire number 6, you get less than that down the line. Nikki has a question here about what portion of US startups do we estimate are covered by Carta? Depends on the market, but it's at least half. So remember, your co-founder is like your spouse, except for more so, because you're going to spend more time with them than you will with your spouse in most cases. That's not data from us. That's just anecdote. And if you want this founder ownership study, it comes out next week, and it's going to be really impactful for setting up how much you as founder should own over time. Pre-seed. First thing that you should know about pre-seed is a lot of founders are asking themselves this specific question. Do I really need to fundraise? No, seriously, VC is incredibly expensive capital. How about bootstrapping? Bootstrapping has experienced a renaissance over the last couple of years. Many more founders are trying to see how far they can take the business without raising venture capital. And I think that is wonderful. Most companies should not raise VC. But if you're going to raise VC, you're probably going to start on safes. About 90% of all the pre-seed rounds, pre-priced rounds we're seeing on Carta are using safes. That's the black lines. The blue lines are convertible notes. You may use a convertible note if you are in biotech or a sort of a more hard tech field, but most of the time software companies are raising on safes these days. Depending on how much you're raising, you're going to need to add more safe investors. So if you're raising about $500,000, typically we see that coming from between 4 and 9 investors. So 4 and 9 individuals who give you money on safes. If you're raising $5 million, that might be as high as 15 or 17 different investors. So these safe rounds can get pretty big because they're on a rolling basis. You don't need to aggregate them up on a round. You can have a conversation with an investor. They can wire you cash that day and you just keep building. Terms of safes, 90% have a valuation cap. So you just got to get comfortable with what you think your valuation cap should be. About 35% have a discount. And then if you get an uncapped, undiscounted safe, that's from your parents. Nobody gives you that deal. Most safes are post-money safes these days, probably because that's the template that is on the Y Combinator website. If you're using Carta, you could use either pre or post-money, but your investors are probably going to ask for post. In terms of the valuation caps, an easy way to think about this is right now on Carta, if you raise $1 million on a safe, the typical valuation cap is $10 million. 1 million raised on a 10 million cap means voila, you just sold 10% of your business for $1 million. Fairly reasonable. Most founders think, or some founders, think that safes are free money. They are not. You are selling equity with a safe should you go to raise priced capital later on. AI companies raising at a slightly higher valuation cap than others, that's probably no surprise. So again, if I'm a founder today, I'm not thinking about my valuation cap that much. I'm thinking about how much dilution am I taking on? What percentage of my company am I selling for that cash? The Shark Tank example. $1 million, is that worth 10% of my company? Maybe today it is. Maybe it's only worth 9%. You got to negotiate on these things. But if you think about it in terms of ownership dilution, I think it's a better mental model than only focusing on the valuation cap. And you better go to a price round later on, Brian says. And I actually agree with him here. If you'd never raise priced funding, there's really no mechanism to convert that safe into equity for your initial safe investors, unless you as the founder are pretty generous. So think about the funding instruments that you're raising on. If you're raising on convertible notes, just know that those come with an interest rate, and that interest rate is obviously sensitive to whatever the heck the Fed is doing. So you can see the black line is the median interest rate on these. It went up in 23 and 24. Now it's creeped down a little bit with recent Fed cuts, but you're going to pay money to get that cash in the door if you're using a convertible note. Simple rule of thumb, if you're raising $1 million or less, do not do it on a price round. It's too expensive. If you're raising about $3 million, that's typically where we see founders make the choice between doing it on safes and doing a traditional price round. If you're raising $5 million, that's still mostly the purview of price round. Safes are great, but staying on safes for too long, 3, 4, 5 rounds on safes, it's really tricky. You may end up selling more of the business than you think, and your investors might get annoyed because they don't actually own any equity in your business yet. You can use carta.com/safes. We can help you model that out for free as well. All right, we are ripping through this. Section number 4, AI and price rounds. This is probably the section you came to listen to. AI valuation. So the top lines, the regular black and orange line there, those are the pre-money valuations of companies year over year. The dotted lines are the cash raised in those seed rounds. So if you look at it in 2024, the median valuation for a seed stage company that was not in AI was about 12.5, 13 million bucks. An AI company was raising at about 18 million bucks on a pre-money valuation. So that is a 42% valuation premium given to AI companies. Whatever headlines you've read about AI and how much investors love them, those are true. I'm here to tell you those are true. About $4 million raised in those AI seed rounds versus about 3.5 in non-AI. So AI is certainly at a premium at this early stage. And if we go to Series A, the picture is about the same, 30% premium given to AI companies. I mean, let's put these numbers in context for a second. If you raise a $51 million pre-money valuation and you raise $12 million, that means that you have raised at a $63 million post-money valuation. $63 million is very expensive historically for a Series A company. Series A companies might not even have full product market fit yet. So 63 million is robust for these kinds of raises. And while fewer companies are actually achieving them, investors do seem to be willing to shell out at high valuations for companies they really believe in. A lot of those companies that they believe in these days are AI companies. How does Carta define an AI company? This is a fantastic question. We did not do an exhaustive analysis of the product or the go-to-market and et cetera on all these companies. Founders told us whether or not they were an AI company. And I can hear the giggles behind this live stream, right? That's so stupid. Founders would just lie about this. Well, maybe, but from the data, investors seem to agree with them about who's getting AI premiums. So the discussion about who is and who is not an AI company is not one that everyone's going to be able to solve for you. But I do think that more and more companies are going to try to describe themselves in an AI specific way moving forward, mostly due to these premiums that are being applied to them. So it's a good question. Series B, no surprise, following the same sort of thing here. There's a 50% premium on pre-money valuation between AI and non-AI companies in Series B. I should have mentioned at the top, the data that I'm showing you now strips out biotech and strips out hardware. So it's just software companies, just to make it a little bit more apples to apples. So Redeem's point here, just use the OpenAI API and then you're an AI company, right? Some people giggle at the idea of that. Some investors don't, right? They just assume that you're going to be doing that because it's the latest tech, and startup founders should be always investigating which technology can make their business models better, even if they don't own or really know too much about that underlying technology. Now you can say those are wrappers. Those aren't going to be worth anything. I think it's kind of wrappers all the way down, right? What is Tableau? What a wrapper on spreadsheets, et cetera, et cetera, et cetera. If you are wondering, okay, does that just SaaS, right? Is that just the Gen AI startups that we're talking about most days? Actually, AI is in all of these different sectors. So the orange bar is the percentage of cash going to AI in that sector, and the black line is the percentage of deals going to AI in that sector. So SaaS, yes, big AI place, but health tech, gaming, fintech, hardware, AI is finding its way into every place. And how much of your business are you expected to sell in order to raise this money? If you are raising a seed round, 20% is still the median amount that you typically sell in a seed, and 20% is still the median amount that you typically sell in a Series A. 20 and 20. Common venture wisdom is holding very clearly there. So why is that? Why does it seem to not change very much? Well, most of the time, that amount of dilution is being dictated by the fund itself, by the economics of the venture fund, rather than by the exact specific needs of the founder. So a lot of the time, the fund wants to own as a lead investor 10 to 12% of your business. In order to do that, it kind of sets the price and then they work backwards from there. You can see dilution kind of bounces around at various stages, but typically what happens is you sell less of your business in those later stage rounds because you're a much, much bigger company. And yes, if you're an AI founder, you can get a slightly better deal sometimes. So instead of selling 20% in your Series A, the median for AI companies last year was 19%. These aren't gigantic gaps, but on the margins, holding a percentage point or two back for the founding team or employees rather than selling it to investors, if you have the market dynamics there, you can push for better deals. Remember, the data we just showed you was just about primary rounds, but a lot of founders are having to go back to their current investors these days and raise bridge rounds. And those bridge rounds cost money. Excuse me, they don't cost money, they cost equity. So if you sell 20% in your Series A primary and you have to go back to your investors that invested into you at a Series A and ask for more cash, they might ask for another 8, 9, 10%. So it can be very expensive to raise bridge rounds. Obviously, it's not something that you go into expecting to do, but just know that equity will come off the table if you need more cash. What to remember about price rounds? Investors seem to be in a deep and committed relationship with AI startups, but of course, winds can change. Obviously, if you spoke to a founder who raised at super high valuations in 2021, they may advise you not to always take the highest valuation. I know that sounds like we're speaking the book for investors, but it is true in some cases. And the third thing is that priced rounds, if you're raising like a priced Series A, those can be really pricey. Those can be very expensive to you as a founder in legal costs and time, et cetera. So we at Carta, if you're on Carta and you want to use a free tool to help you close those rounds faster and have us do some of the admin work instead of paying billable hours for lawyers, check out this deal closings tool. So just Carta deal closings in Google. We can help you save some time if you're raising a priced round. Team dynamics. What happened to all those employees and the people you're building this business with? Okay. This is perhaps the biggest change that happened across venture-backed startups in the last 2 years. All the founders stopped hiring people. Just focus on that black line for a second. That's total number of hires by month across all Carta companies. So this includes the seed stage and pre-seed all the way up through pre-IPO. 70,000 employees hired in January 2022, 27,000 employees hired in January of 2024. That is a massive decrease. And of course, that makes sense. We've read all the layoff headlines and the turmoil that's happening in the job market, but I still think it's underappreciated just how employee constrained a lot of these businesses are trying to be. So this is a major shift. And if you look at this by sector, the orange is people who hired more than people departed. So the ratio in this case is the ratio of new hires to people who left the business by choice or by layoff. You can see that if you look at 2021 energy, that top line, companies in the energy sector hired 4.6 more people than left for every one person that left in 2021. So huge growth. In 2024, you can see that a lot of these sectors are actually shrinking. So as people leave, the startups are not replacing them with backfills. That is, again, a major shift about how companies think about headcount in particular. When you look at this from the employee perspective, you can see that most startup employees do not reach their 4-year mark, which is usually when their full equity grant would have vested. Something like half of startup employees depart within 3 years of joining a company. And in recent cohorts, that 2021 line is the red line there. It's more, you're seeing an increase. Now, that's mostly layoffs and other stuff, but a lot of people also jump ship to different startups. So it's oftentimes the case that if you are a startup employee, you should probably financially plan for you not seeing out the full 4 years of your initial grant. Maybe you will. Maybe you stay at that startup for life, but a lot of times that's not the case. So a couple questions here that are coming in about FTEs with no equity offered. So no, this data is only equity holding employees. If you're talking about the ideas of not hiring means contract, we are seeing more companies try different arrangements with contract only employees, non-FTEs, or even outsourcing whole job functions to other locales. That's happening, but on the margins, for most of early stage tech, for instance, it used to be that most full-time employees would receive equity. That's still the case. We're just hiring less. Andrew, you have a good question here about what that says about 2025. I'm going to get to it in a second. So this is employees departing. This is a question I get all the time. What happened to remote work? Sadly, we're seeing, not just remote work, but hey, if I get hired and I'm working remotely, my startup is located in San Francisco. I am located in Austin, Texas. Am I going to get paid the same amount as somebody who's working in San Francisco at my same job? The answer is no, you're not. The vast majority of startups and even big tech companies adjust pay depending on where you live. So there was a moment in 2021 where it kind of felt like people were experimenting with the idea of perhaps paying everyone equally for the same job, no matter where they happen to be. That world is not with us anymore. Geolocating salaries is by far the norm across big tech and little tech. So fewer hires, and the hires that are happening have left at increased rates sometimes. What does that mean in terms of total headcount? Well, this is a chart that shows you on the day of a fundraise, how many people, full-time equity holding employees, worked at this company. So at Series A, for instance, if you raised your Series A in the first half of 2020, the median amount of people that worked at your company was about 20 full-time employees. If you did that same raise in 2024, the median amount was 16 employees. And it's actually gone lower in the second half of 2024 as well. So this idea that has been floating around that you need fewer headcount due to AI or other things, I think it's actually very true. Now, whether or not people are actually replacing them with AI or they just overhired and they're using a leaner team now, kind of debatable. David says the exception is AI talent. Location doesn't matter. Our data doesn't agree with that at the employee level, but it definitely agrees with that at the executive level. So if you are an executive, if you're trying to get hired as a VP or above at a startup, the market is a lot more national than if you're an individual contributor. Then the market is geolocated a lot more often. Are LPs looking to invest in funds that focus on investing in smaller teams? Hell yeah, they are, man. Not just LPs, but GPs too. It is the wave of today. So within the people that are getting hired, who are these people? There's this meme going around there. I think Zuck talked about it a little bit on a recent podcast that AI is going to replace engineering talent. We haven't seen that yet for startups. Engineers are still the biggest category of new hires, followed by salespeople, and then on down the line. And more of those new hires happen to be individual contributors. It used to be that, in 2019, 2020, there was a pretty, even split between ICs and managers. So that managerial level is getting hollowed out a little bit. You still hire some same amount of execs-ish, but more individual contributors than you used to. And this is, I mean, this is to me, this is the money slide, right? This tells you exactly what's going on with comp. So what this slide shows is that if I, Peter, were hired at startup XYZ in November of 2022, and then somebody was hired into my exact same role, exact same level in April of 2024, what's the difference in our comp packages? In salary, it's basically flat. We basically get the same thing, those two hypothetical Peters. But in equity, the Peter that was hired in November 2022 is getting about 36% more equity than the Peter that was hired in April of 2024. So that's a huge change. Why has that happened? Number one, companies got really scared by their boards about how much they're burning in terms of their equity pool. Number two, candidates actually sometimes prefer cash now to equity because of the general wave and air around startups. And number three, and I think crucially, a lot of times a candidate will walk in with a very clear ask or idea about the range they want for salary and very little idea about what the right range is for equity. So that can be really difficult to know whether or not you're getting screwed. Side note, if you want to change that a little bit, if you were looking for data on you're getting hired at a startup, you can go to carta.com/friend. So that has real data on salary and equity right now for your positions. Share it with a friend. Only friends. Salary adjusted for inflation, inflation adjusted, no and no. These are not inflation adjusted. So on a inflation adjusted basis, yes, salaries have gone down about 10 to 12%, depending on what you want. One of the tricky questions here is oftentimes people who are thinking about joining startups are not only thinking about joining super small startups, they're kind of open to a range of different sizes. And so we decided to compare what does a director salary look like at a company worth 50 million, so Series A-ish, versus 500 million, much, much bigger. And the gap between those salaries, depending on it changes a little bit depending on what function you're in. It's about 20%. So you make 20% more in base salary cash for the company worth 500 million than you do for the company worth 50 million. That kind of struck me as low, but of course the equity is much higher at the company that's worth 50 million, but also riskier because probably if it's worth 50 million, there's less of a chance it's going to turn into anything than the company that's already worth 500. So it's a really interesting mental model that employees got to walk in with of what matters to you, higher base versus the upside potential of more equity. All right, ripping through this really quickly. How did equity and comp change depending on where you lived? So if we just take San Francisco as 100%, what percentage, discount should you expect if you're getting hired, say, in Raleigh, North Carolina? Well, from our data, it shows that Raleigh employees are paid about 90% of what SF employees are paid. But of course, Raleigh costs of living, rent, food, whatever, might be much more discounted than 90%. So you could be coming out ahead there if you're in Raleigh. Raleigh. I got it. The Midwest, we saw some strong increases. So all these places moved a little bit closer to San Francisco. Really cool to see, Detroit, St. Louis. Yes, you're making about 85% of what your compatriots in SF are making, but I'd be really shocked if living in Detroit wasn't more than 15% cheaper than living in SF. One of the questions that we get a lot is, okay, I understand that people make less depending on where they live. But round sizes, these companies are also raising rounds in different places. And how does that work when you're paying people less, but you also raise less money? So the round in Detroit, the seed round in Detroit is probably smaller than the seed round in SF. And what we find when we compare these two things is that actually, usually the round in SF more than makes up for the increase in salaries. So the rounds in SF are big enough that they usually swamp any sort of advantage that you would have with hiring talent. So this is one of the arguments that people make for investing into non-SF rounds is, man, talent is so expensive. And it's true, but the rounds are correspondingly bigger. Couple last points on equity and comp. This is a pretty stunning chart to me. So what this line shows you is the percent of in the money vested equity that employees choose to exercise before they leave. Again, this is vested and it's in the money, meaning as far as we know, the shares are worth more today than they were when they were granted based on the 409A valuation. And still, about 70% of all these options are not exercised before the employee leaves. So what is going on? A couple points. First, usually the employee has 90 days to make this choice. 90 days to gather up what might be 5 figures or even higher worth of cash to exercise these options. That can be really challenging. Two, maybe the current in the money status of these options is a little bit cloudy and the employee knows more than we do. And they're actually making a pretty smart financial choice based on their expectations. Hey, is this company going to be worth anything in the future? Three, as Lily just mentioned, taxes. Yes, that could be a problem. Susie, your question, is this because there's no event? No, so this is based on employees who left. So they kind of have to make the choice about whether or not they exercise or not exercise their equity. Remember, if they don't exercise it, it's gone. It's as though they never had equity in that business in any case. So, only about half the time was this exercised even in the boom times of 2021, but 32%, that means that employees are mostly a little bit down on the promise of equity. And they're probably, I got to guess here, making smart financial choices for themselves and their family based on how they value cash today versus the promise of cash in the future. Yes, Andrew, this does count people who were let go as well as those leaving by choice. As you can imagine, if you're laid off by a startup and then you are faced with having the choice to purchase shares in said startup in the next 90 days, maybe you say, screw that place. No, thank you. And again, only 1 in 5 employees have more than 90 days to exercise. So yeah, well, lack of money to invest, Susie, also a great point. These are a lot of choices. And this is why equity, while it's a wonderful tool for retention and it can be life-changing when it works really well, employees need to be smart about whether or not they're making good financial choices on equity all through the stages. Carta can help with that. It's carta.com/equity if you want to learn about equity and how it works. We want to educate you. Okay. What should you remember from this section? First, ARR per employee. That is not just a buzz tagline that's being thrown around. That is core to what many founders are thinking about in terms of their business. How big can I get this business with as few employees as possible? One, equity comp moves a lot more than salary because it's harder to understand for employees and it's easier to adjust. Third, AI has not replaced engineers yet, but come back and watch this in 2025 and laugh at me if I'm wrong there after this year. Metro area comparisons. Maybe this is what you came for. Got a rep for your city here. First off, California, still the home of startups, taking in nearly 60% of all dollars invested into startups on Carta in 2024. So California dominates. Then you've got the big players in New York, Massachusetts, et cetera, down the line, growing ecosystems in Texas and Florida as well. Let's run through some of these more specific metro areas. So Bay Area, if you look on the left-hand column, that's just overall capital raised by startups located in that metro area. So company HQ is what we're using to decide the location. And then each one of those sectors as well, same thing, company HQ in SaaS, in biotech, et cetera. First one, Bay Area. It's the first spot in 4 of 6, and it's the second spot in the other 2. So any stories that you've read on Twitter or elsewhere about the death of the Bay Area as the home of startups, those are wrong. New York. I think it was a great bounce back year from New York. 2023, we actually saw Boston catch up to New York. And then in 2024, New York sort of reestablished that lead there's really 2 incredibly developed, mature ecosystems in US startups, Bay Area and Bay Area and New York, excuse me. New York is super strong in fintech, as you might imagine, great in SaaS, but it's actually very diverse ecosystem too. It works across all sectors. Boston, great ecosystem that used to be, if we were having this discussion 5 years ago, it's basically biotech and then nothing else. But I've been really impressed with the way that the Boston ecosystem has kind of moved from biotech into a ton of other sectors. So third in SaaS, really impressive. Third in health tech, also very impressive. Not a lot of consumer in Boston, but that's okay. Los Angeles, wonderful place to start a startup. Fourth in our ranking, but like neck and neck with Boston for number 3. You've got SaaS, you've got hardware, you've got defense tech, you've got health tech, you've got obviously a ton of consumer. So LA is a fantastic place to start up. And shouts and thoughts and support to everyone who's joining here from LA. Hope you're all safe and doing well from those fires. And then lastly, Austin, rounding out the top 5. Again, a bit of a gap between those top 4 and then Austin. Los Angeles is at about 8.5 to 9% of total cash invested. Austin is at 3%. So 5 through 10 are much lower than those top 4. And Austin kind of has 2 different points of focus. It's good in SaaS and it's quite good in hardware. A lot of space tech in Texas, et cetera. So maybe a little bit less in consumer fintech along the way, but Austin has sort of built itself into a really well-rounded ecosystem as well. If we just look at AI funding, so if AI is the next wave of startups, and it has been the focus of a lot of VCs over the last couple of years, the Bay Area sort of share of voice here dominates even more than it does for general startups. So in our data, about half of the dollars invested into AI are going to the Bay Area. And if you look at late stage, that's even higher. So it's a lot of AI startups in the Bay, although AI startups are becoming more common in other places as well. Deep tech, there's some questions here about deep tech or how I define hardware. Those are labels that the founders have applied to their own businesses. Deep tech, depending on who you talk to, means 4 or 5 different things. So I would split it in mostly biotech, hardware, and then advanced sciences. There's a lot of difference there. We kind of go by what the founders tells us about their business. Are we planning to collect data on Canadian cities? We already do. We don't put it out because it's not quite as robust as this, but hopefully this year we can help you with that. Let's go San Diego. Now I'm just running down the list. This is fun. Austin is slipping historically. No, I'd say Austin has risen over the last 10 years, way bigger for Austin than it was 10 years ago. And then these are unrelated, but average ticket size in a pre-seed safe for an AI startup. Ticket size, by that I hope you mean safes. That's mostly like $50,000. But hey, the round is probably going to be raised somewhere between, 1 to 2.5 million. Those were unrelated. Let's move on. Everyone's favorite punching bag and or city to love on Twitter, Miami. I love this as a use case. Miami is doing incredibly well and poorly at the same time. That seems silly. How could it do both? Well, depending on where you look in the fundraising cycle, Miami is doing well or doing poorly. If you are looking for really big billion-dollar rounds in Miami, you're not going to find them. Why? Because the startups that would raise billion-dollar rounds are not old enough in Miami to have gotten there. So you have to look at ecosystem growth by stage to get a good, fair indication of what's going on in those ecosystems. And what this chart shows you is that for pre-priced rounds, so safes and notes, over the last, call it year or so, Miami ranks 6th in our data in pre-priced funding on safes and notes. That's great. That's much higher than it used to be. 8th and seed, 10th or so on Series A, and then way down for late stage. So, to laugh at Miami because they can't raise billion-dollar rounds is kind of silly. The companies aren't old enough yet. I think Miami's actually done a really good job establishing itself as an ecosystem. Now we'll see if that can hold in 2025 and beyond. Shouts out to any Miami watchers and listeners who've joined us. Winner deals completed. This actually shows you basically what you already knew, which is December, while it is the best month typically for signed deals, not a lot of new deals get started in December. So that's why January and February are lower in terms of percentage share, and then things pick back up in March. So if you're trying to get something signed on New Year's Eve, that might happen. If you're trying to get something started on New Year's Eve, you probably waited until this week or last week to get those conversations going. What to remember, don't bet against the Bay. It's not going to work out for you. And then a lot of places across the US support seed and Series A companies. Will they move up the chain to Series B and Series C? Or will many of those companies leave and depart to the Bay or New York to get that late stage capital? I think that's a big unanswered question. Fund performance. Of course, we talk about startups all the time, but Carta also manages the back office for about 2,500 venture funds. And they are getting impacted by the same things that their founders are. So we analyzed 1,800 venture funds, most of them on the smaller end. So had raised between, say, 25 million and call it $100 million in fund AUM. Here's the performance of those funds. You're looking for higher IRRs on the upper end, lower IRRs, in more recent years. Obviously, the point of a lot of this data is venture funds take a long time to mature. So if you're judging a fund performance after a year, you're probably not going to like the numbers because there hasn't been long enough for those investments to grow over time. Whereas in 2017, you're seeing some pretty reasonable IRRs above 20 at the 75th percentile and then above 30 for those top decile funds. This is just a look. If you're a founder and you're wondering what the heck these charts are, typically a J curve appears in venture fund performance, whereas the fund actually does negative IRR at the beginning because they're spending money. And then as the investments that they made get bigger and bigger, they climb back into positive territory. And you can see that starting to happen a little bit with 22 and 21. And then the earlier years kind of shot up because it was such a boom time. And then they've kind of flattened out lately as performance has declined a little bit with all the turmoil that we've seen across startups. Smaller funds do tend to outperform bigger funds in some cases. There's some nuance to this. Don't take this as gospel. We're doing more work on it soon. TVPI is same thing as IRR. The more recent the fund, the more difficult it is to judge whether or not they're good or bad. And then this is the ultimate metric. How many of these funds are actually giving money back to their investors? Again, if you have DPI after 3 years and you're a venture fund, maybe that's not actually good because you want to hold your money, your winners for longer than that. But you can see that in more recent vintages, there's been fewer and fewer funds that have any DPI. So if you're wondering what conversations are happening between your investors and their investors, their LPs, this is what they're talking about. They're talking about, hey, when are we going to get our money back? And for the last few years, that has been a difficult conversation for a lot of fund managers. What to remember about fund performance? Whatever happens in startups is going to show up in the fund performance numbers at about a 2-year delay. There are going to be a lot of VCs, and I say this with sadness, that are going to be doing something else in 3 to 5 years. Again, just as there was a boom in startups in 21, there was a boom in venture funds in 21 as well. And many of them won't end up becoming household names or lasting firms. And it's my contention that we should start talking about VC as 2 different things, emerging and established managers, rather than lumping them all together and then just being consistently annoyed that Andreessen Horowitz is raising all the capital. All right, exits. Let's talk about them. So one way to exit is, of course, to shut down, which is very sad. But this slide is only here to tell you that you are going to read about headlines about big startups shutting down more often this year. Every big startup that raised $100 million or more is a very easy target for a headline. And those sometimes are useful stories, but just prepare yourself. We funded a ton of startups in 2021. Not all of them are going to IPO. So some of them are going to end up shutting down. And you can see that the inverse between time of funding and then shutdowns runs about 3 to 4 years after. So this is about, this slide really, DPI. How can a VC make a case that they deserve LP capital if competition for capital is much higher? I am not a VC. That is the core problem that they have to solve. Hopefully it has to do with their access to deal flow, their financial modeling capabilities, their closeness to wonderful founders. There's a lot of cases to be made. LPs are historically, or were a little bit more open to new cases in 21. It's a difficult case to make right now in 2024. You got to be a really, really good GP. All right, back to exits. IPOs. So this is really where a lot of the money gets recycled back into startups. And look at those numbers from 22, 23, and 24. So small. The smallest we've seen in many years. So knock on wood, we're hoping that 2025 is a better year for IPOs. I would not expect 140 tech companies to IPO this year, but hey, 15 to 20, I'll take it. We just need some progress up and to the right. That IRR is net, not gross. On the positive side, we are seeing more startups that are getting acquired. Now, before you ask, I don't know whether or not these are just fire sales and acqui-hires and nobody made any money, or if they're real substantial acquisitions. Both are happening, probably a little bit more of the former than the latter, but it is good to see that there are buyers for startups out there and they are interested in these sectors. Some of them are big tech, some of them are other startups, and some of them are PE shops that are trying to do roll-ups. All three of those buyers exist. And we're also seeing some increase in secondary market activity. So secondaries are a way for founders and early investors and early employees to offload some of their shares on the private market before a company IPOs. We're seeing a little bit of an uptick in this. Probably we're going to see more of an uptick in that over time. There's one thing to take away about exits. You can read all you want about mergers and secondaries. They cannot take the place of a healthy IPO market. We need IPOs. Absolutely need them back. So my ask for you, get on the phone. If you know a late stage founder who's thinking about IPOing, tell them that we would love them to for the good of the whole ecosystem. That's a difficult phone call, but I'm asking you to make it for us. And then the third point is exits are a lagging indicator of the health of an ecosystem. So a lot has to go right before a company IPOs or gets bought. So as these exits turn up, I think that's actually means that things were actually looking up a little bit before you see the numbers start climbing. Team, that was a long hour of talking. I hope some of it at least was interesting to you. My last note, again, this is, I think, one of the best data analysis pieces we've ever produced about how much equity founders own at the start, at seed, A, B, C, D, and right before IPO. So if you want to learn about how much equity founding teams own in those companies, scan the QR code, join the newsletter. I'll send it out to you early next week. I have 1 minute here for a last couple questions if you want to drop things in the comments. Kevin, to your point, secondary transaction volume, it is something that we're thinking about reporting on more next year. Got to be a little nuanced about it, but yes, I hear you, and that is noted. Again, I will put the deck that we just went through into a link in the LinkedIn comments. So if it's not there right now, check back in like 5 minutes and it will be. This recording will live here in infamy and posterity, so feel free to share it with your friends. And then if you want to get this study, jump onto our QR code, join the data newsletter. We put out new data every week. Wow, so many thank yous. This was great, team. I really appreciate it. Hopefully we got enough of your questions in. If LinkedIn is listening, I would love to be able to bring people who are watching the live stream up on camera. I don't know why I'm shouting at you. I'm shouting at LinkedIn. I think that'd be a great feature ad. So please make that happen, LinkedIn. And we won't wait a full year to do this again. I promise. I will talk to you soon. Thanks so much for spending time with us.